Hello and welcome. You're tuned into the special edition of Mutual Fund Corner, and today joining me is Mr. Arun Chulani, who is the co-founder First Water Capital Fund. Arun, good afternoon. Thank you so much for joining us, and it's a special mutual fund edition that we are hosting. So thanks a lot for being a part of it. And we're going to be discussing credit risk funds because that has been in focus, whether they make sense because they are high risk funds, something that we've been talking about as well. So the first question is really that at this juncture, what is your take on credit funds? Should people switch out of these to other debt funds? Is it generally a category that you look at?
Hi, thank you, Sonal. It's a real pleasure to be here. Yeah, it's a good question. I'm not really personally a fan of credit risk funds, and of course, I reserve the right to be wrong. But essentially, in terms of risk reward, it doesn't seem to give you, that compensate amount of return for the additional risk that you'll be taking, because you'll be buying into all credit risk funds usually have 65% and lower quality paper. We're going into global headwinds, earnings may deteriorate, plus you've got to pay a higher management fee. So all these factors put together, at least to me, don't sound very exciting.
So if not these, what are the kind of funds that do you think that at this point in time an investor should look at? I do have some of them, the target maturity funds. Can you elaborate a little bit more on that?
Mm-hmm. Sure. So I would really be focusing on higher quality funds with good quality paper, AAA, target maturity funds or accrual funds, whereby your money, maybe your returns aren't as good, but you get the benefits from long-term capital gains plus indexation, as well as the fact that essentially you are around the 7% mark. So from many perspectives, you are getting a good return, less risk, and you're benefiting from the long-term capital gains.
Okay, so I know that these funds do not excite you so much, that is the credit risk funds. But if someone does have the risk-taking capability, do you think there should be some exposure to these funds in the portfolio, or do you think it's a big no-no, completely avoidable?
Yeah, I mean, you're taking the risk of, and you're getting a limited upside. That to me doesn't really make sense. Again, it's from a personal perspective. So rather than go for like additional returns through credit risk funds, I would perhaps adjust your asset allocation towards equities because effectively you are getting unlimited, possibly unlimited returns. Yes, you're going to take a bit of volatility, but it seems that you'll be taking the same or you'll be taking some form of volatility with credit risk funds. And essentially, you're buying into the wealth creation of the Indian growth story. So essentially, I would really pick equity over credit risk funds.
Okay, equity over credit risk funds. So let's take a deep dive into that, because when you're talking about equity funds, we are in a very volatile environment right now, right? So in that case, should someone look at large cap funds or passive but large cap funds? In the equity category, what do you really like and why?
Yeah, I mean, if if we're sticking to those two elements, I would go for an active manager over an index or passive fund. I mean, you're taking on an index level, you may be taking inadvertent risk towards a certain group. For instance, in the Nifty 50, the Tata 5 companies that are listed there have 8.5% of the index. Also, government companies, PSUs, are generally quite large, and sometimes they feature quite heavily in the index. And the general thought process is government companies, PSUs are inefficiently managed. So again, you're taking perhaps a risk towards those sectors that you wouldn't ordinarily wish to. And from what I understand, active managers have generally outperformed the index. So I would rather go towards an active manager, and whether it's large caps, again, it depends on your risk profile. For me, I'm more of a mid-cap focused player. But again, depending on someone's risk profile, they may want to have less volatility and focus on blue chip quality names.
Okay, so when we're talking about equity, that part is covered because, but we are in a rising interest rate scenario as well, right? Should an investor make a switch from equity to debt funds? Is that something that you like?
Yeah, I don't know. I don't think so. I would say an investor, or again, the advice to myself that I would give is to stagger in, average in, whether you're moving into debt or you're averaging into equities, average into the market. I would have a long-term play. Sure, you're going to have some volatility, but by averaging in, let's say the market falls and you have still a tranche of money coming in, then that through averaging, you are averaging your loss. Should the market fall against you, you're averaging your loss in the market and you're averaging your time in the market. So I wouldn't really make a switch from equity to debt. I would have an equal play depending on your asset allocation portfolio and your risk profile. And I would continually average into the market, whether it's the debt funds or whether it's the equity funds.
All right. Interesting take there, because most of the fund managers that we speak to are talking about how debt funds could be a good way to look at investing as well at this point in time. Last question before we let you go, and just a general perspective is what I wanted. You are bullish on the equity side. Do you think international funds is something that makes up for an interesting bet right now? Because we are talking about, a lot of these funds stopping subscriptions because of reaching or breaching that limit as far as international investments are concerned. And also this TCS, or tax collected at source, which has been increased to 20% versus 5%. What does it look like as far as international investments are concerned?
Sure. The increase in TCS certainly puts a dampener on anyone looking to invest internationally. But from an Indian perspective, essentially, you're looking to diversify. And by being in India, one would probably have a direct impact, whether you're an income, an entrepreneur, or a businessman. Your assets are probably within India. And then if you're just forced or pushed towards investing in India, you're taking a significant geographic risk. So international funds do make some sense to diversify that risk, to create a more all-weather portfolio. And certainly there are countries that you want to be looking at that may have the same kind of macro factors as India, or you may wish to go to the West for their certain demographics or the tech or fast-growing sectors. So yes, they do make sense, but within proportion. Again, it all very much depends on how much you're concentrated in India and how much of let's say, how keen you are to be part of the global perspective.
Okay, so asset allocation, of course, is the key, and how much risk can you take considering the environment that we are in. Arun, it was a pleasure speaking with you. Thank you so much for joining us here on CNBC-TV18, and hope to speak to you very soon again on Mutual Fund Corner.
Sure. Thanks so much. Thanks so much, Sonal.
All right.